Good afternoon. Welcome to LBMA webinars. Today we are talking inflation, central bank policies, and the macroeconomy. Here to join us, we have James Steele, who works for HSBC Securities. My apologies. We have Rhona O'Connell, who works for StoneX Financial Ltd, and we have Suki Cooper, who works for Standard Chartered Bank. Now I'm going to take you through a quick housekeeping slide before I hand over to our panelists. If you do have any questions, we will either take these throughout the webinar or towards the end. Just drop them in the Q&A panel, either at the bottom or the top of your screen, depending on which version you're using. If you're not sure how to find it or can't access it, just email us at ask@lbma.org.uk. This applies for you as well if you are watching this back recorded later. Email us your questions and we'll make sure to get those to your panelists. After a round of applause, we're going to hand over to James Steele whenever you are ready.
Yes, indeed. Thank you very much, everybody. It's a pleasure to be with you all. I'm James Steele, HSBC's Chief Precious Metals Analyst, here to discuss, in particular, the geopolitical and the trade relations of the gold market. And we can move on to that first slide. Thank you very much, Taylor. Well, you know, here we have world events from 2019 to date, and the gold price. I think just to make a few comments in general about the markets and the relationship with geopolitics. Generally speaking, geopolitics is not a prime driver of the gold market, but that's changed this year with the invasion of Ukraine. And geopolitics and the impact of geopolitics has been elevated to front and center, without doubt, as far as driving the price of gold. But a little bit of history, I think, will help us. You know, I often get telephone calls from clients and participants in the market that look at any one event in the market, say something in the Middle East, or a geopolitical event, that is, something going on in the Middle East, or something in Asia, and they see a relatively tame or modest response by the gold market. And they say, you know, James, I don't know if gold has a geopolitical dimension to it anymore. But in our view, that is not the correct way to look at it. It is not so much any one event, although Ukraine is to the side of this as a special event. It is the frequency of these events that has a big impact on the gold market. Now, what do I mean by that? Well, what the IMF and the World Bank term as a geopolitical event is an event that happens in one country, but has regional or global dimensions. So an event that doesn't impact anything outside of a country is not a geopolitical event necessarily. And mostly speaking, geopolitical events have negative consequences. They are risky events. And the fact of the matter is that we've had more of these events in the last few years than we have in the previous 10 or 15 years. So this is helping to put an undercarriage underneath the gold market. And that's what's important to point out, that the world is effectively getting riskier. And as a consequence, we've seen the World Bank and the IMF and others make comments on this. And the fact that we have entering into a riskier period, have been in a riskier period of quite some time, has created more safe haven demand for gold than, say, in the previous 10 or 20 years or so. Now, the impact on gold of geopolitical events is usually relatively short-lived, having said that. And if you look at the last, say, few important geopolitical events, and I'm just you'd have looked up a couple as a good example. The Crimean events in 2014 with the Russian invasion and taking of Crimea, and also 9/11 and Brexit. We got big percentage moves in the gold market on each of these events. But the gold did tend to give up a portion of those gains in the aftermath. And I think that's important, that geopolitical events also by definition, get some sort of resolution or some sort of remedy, or at least some sort of calming down. It might not be to any particular country's a satisfaction, but when the geopolitical risk thermometer eases, drops for whatever reason, the gold market tends to give much of the gain back. And I think that's important. I don't know what's going to happen in Ukraine, no one does. But I do believe that if the geopolitical risk thermometer were to ease, we would see a reduction, therefore, in the safe haven buying of gold. Now, it is important to remember that the geopolitical issues surrounding the invasion have elevated risk to a whole new level. It is the first major conflict in Europe since the Balkan Wars and its membership of Yugoslavia, and as a consequence, it has important ramifications, and we simply can't ignore this. And this, we think, is going to have a longer lasting impact on the gold market. For example, Ken Rogoff at Harvard, who many of you will know, the head of the faculty, published a paper recently, Is the Peace Dividend Over?, in which he speculated that the end of the Cold War had increased equity values, had led to a drop in inflation, a drop in interest rates from what they would have been otherwise. And this was negative. This was, generally speaking, negative for gold. As we saw a prolonged period of bear market in gold from the 90s right through until the early part of this century, and it wasn't until risks began to rise again that gold moved higher. Now, if we're entering a period where the peace dividend is over, I think it's fair to assess and assume that gold will have an elevated levels from what it would have been otherwise. It's not to say it's going to stay where it is now, but it will be higher otherwise. And this was sort of repeated by the Eurasia Group, who said that we're going to see greater military expenditures. For sure, NATO will be elevated, and that geopolitical risks will remain relatively high going forward, unlike during the period where risks were easing. So out of this, rather tragic events and the shift in geopolitics, we're going to see higher gold prices than we would have seen otherwise. And this feeds through a little bit into trade. That's our next slide, if you don't mind, Taylor, where we show these are percentage exports from the world's major trading blocs. Latin America, the United States, Africa, the European Union, and Asia. And we put it against the price of gold. Now, there is an inverse relationship between gold and trade. Economists tell us a number of things happen when when trade increases at above average growth rates, and particularly for countries that participate most heavily in trade. Inflation goes down because the cheapest goods and services are being traded. In addition, equity markets tend to rise, led by export-led companies. The law of comparative advantage says that growth will be higher than otherwise would be the case. Unemployment tends to fall. The dollar tends to be strong because you need the dollar to conduct the vast majority of world trade, and risks, geopolitical risks, tend to drop. So if I said all of those things to you, inflation will be down, growth will be up, unemployment will fall, risks will be lower, the stock market will be strong. Do you want to own a lot of gold? Well, you probably wouldn't want to own a great deal. And as a consequence, when trade grows quickly, the gold market tends to be weak. But when trade declines, when the growth slows, or especially when it contracts, as it did during the global financial crisis, the gold market moves up quite convincingly. And even when trade just bumps along at low levels, as it did sort of in the middle part of this decade, the gold market can hold its own. More recently, we've seen another decline in trade related to COVID, and now again related to, in part, the issues surrounding Ukraine, and also a general slowness, increase in trade frictions, and the gold market has tended to prosper. Now, there is a bit of a lag here. I wouldn't say that they move lockstep, but I do think it's something to bear in mind that declines in world trade tend to echo, and real trade frictions tend to echo setbacks in globalization. And globalization, by and large, because of economic reform, because of movements in human civil rights, et cetera, and greater amount of trade and freely flowing populations, has tended to be negative for gold, and setbacks do tend to be more positive for gold. And as these political scientists have mentioned, the Eurasia Group, and also Ken Rogoff's comments about is the peace dividend over, this would tend to usher in maybe tougher trade future going forward, and higher than we've seen in the past 20 years or so geopolitical risks. And just a quick comment, I mean, the World Trade Organization reduced its growth in trade this year from 4.7% to 2.5%. And I think that's important. And although our trade economist had commented that although Russia and Ukraine don't have a great deal of world trade, they export some key commodities, and that has a knock-on effect into trade in general. So I think that the geopolitical dimension to the gold market has been elevated. The trade dimension is often not spoken about, but I think it's important. And going forward, I would expect relatively higher geopolitical risks than we've seen historically, or at least in most people's lifetimes, that would keep the market rather elevated and inject a certain level of volatility, even if prices do not stay quite as high as where they are now. And I would welcome my colleagues, Rhona and Suki, to have any comments on, here's our disclosures, of course, to welcome any comments on what I've just said before I think Rhona then moves on to the topics that she's going to discuss.
Okay, shall I
lead
off?
Thank you very much, everybody.
Thank you, Jim. Shall I lead off, Suki? Then we'll come back to you, and then we'll come back to me, so that people don't have to listen to me for an extended period of time. A couple of things come to mind from that. That was fascinating, Jim. Thank you. Very interesting, particularly about the trade. And a couple of things come to mind. I'll have a quick thought about trade first, which obviously with what we've got at the moment, with this horrible situation over in Ukraine, as far as the knock-on effect onto specific commodities are concerned, Russia and the Ukraine between them account for roughly 30% of the world's wheat supply. But a slightly more nuanced side effect of what's happening over there is that Ukraine is responsible for roughly 50% of the world's neon gas supplies, and neon is essential for the laser engraving of semiconductors. So it was starting to look a month or so ago as if we were getting some light at the end of the semiconductor supply dislocation tunnel. It's now starting to look as if it's turning again into the approaching train, which is another sad side effect. But from a financial standpoint, when you were talking about geopolitical impact on gold and it moves, and then in the aftermath, it'll give some of it back. Certainly, I've had calls with people before who've said, well, why isn't the price higher? And you could argue, obviously it depends on the circumstances, that if that geopolitical impact hadn't come into the markets, then the price would actually have been lower. So one can't say that there is no impact. It's just that it might be offsetting other more negative elements. But the thing which did spring to mind from my standpoint with respect to sort of distress and liquidity, and you're talking about how gold giving things back, the meltdown in the commodities markets as the COVID virus took hold in sort of late February, early March 2019. Gold took a big hit, as it always does when there's financial stress because of the liquidity element, and it comes into its own as an insurance policy being cashed in. But then people were re-establishing their positions. So while everything else fell, and in many cases stayed down for months, And certainly in the case of silver and platinum, it was 11 months up to a year, and the stock markets were even longer than that. Gold actually recouped all its losses within 5 weeks, and it was far and away the quickest one to recover, thereby demonstrating that people had, as is frequently the case, once they've used it to get them out of a distress situation, they then reinvest to re-establish that insurance position.
That's a very good point, and just to emphasize one of the couple of the things you've said about gold, while not necessarily going that much higher, may have been higher than would otherwise have been the case without the geopolitical element. And the empirical studies, and I would point out Dirk Bauer's work here, Gold and Geopolitical Risk, has pointed out that gold, not only does gold outperform other assets during periods of elevated political risk, it also outperforms other commodities, including other precious metals. And so the empirical evidence is there for gold's status in this regard.
I wanted to add that, Jim, I really enjoyed looking at those charts. I think it's nice to be able to put into a graph just the impact that the geopolitical events have had on gold, but also just to be able to quantify what's happening in terms of world trade. And I agree that we've seen a higher gold price on the back of the geopolitical risks. We've done some analysis looking at if gold was just following real yields, if that was its primary driver, prices are more likely to be trading around $1,800 per ounce. So we're seeing quite a significant geopolitical risk premium at the moment. But there's also questions on both sides of the table. Why gold prices not trading higher, but also why are they not trading lower, given the potential hikes that we could see from the Fed and central banks around the world. And I think this is gold pulling and being pulled and pushed in both directions. And it's found that happy medium for now, above 1,900, but not quite being able to reach $2,000 per ounce. When we've looked at geopolitical events of the past, we've generally seen that in the first month after a risk event occurs, that's when gold prices tend to gain momentum. And then they start to surrender those gains within 3 months of that initial risk event. So we do tend to, on average, see a positive effect in manifesting itself in gold prices. But I think what's made this event different is a knock-on effect in terms of the concerns around inflation and supply chains as well. And that's, for gold at least, driven the interest just from a geopolitical interest towards maybe we need to hold gold as an inflation hedge or as a risk hedge, or just as a broader need for gold within a portfolio. So I think initially the impact has been around the uncertainty, but now it's started to feed into macro models as well. But if we look at market positioning in gold, we've seen that that's followed a very similar trend. We tend to see a build in short-term tactical interest in gold, at least initially. And then if investors feel they need to keep gold exposure, they might rotate into physical gold, whether that's ETFs or allocated bars. And we've started to see that tactical positioning has started to come off and is actually now back at levels before Russia invaded Ukraine. So the market has responded to a large extent how we've seen the historical patterns suggest gold prices would respond, but also now it's being pulled and pushed by a number of moving dynamics.
Yeah, I think that's right, and it just shows, the universality of gold. It's not, it's multidimensional. It's open to a whole range of influences. You look at palladium, and you really got to look at auto demand, and it is far more multifaceted than that, and it's feeding through into yields and to Ukraine, the events in Ukraine, feeding through into yields, feeding through, as you say, into impacting global monetary policies, fiscal policies, and all of this is having a knock-on effect into the gold market. And just one last comment about geopolitics and how it impacts the gold price in many indirect ways. It was the end of I remember back in the 90s when we saw repeated central bank selling, beginning in 1991, going right through into the next century. And it was a bit of a puzzle at first until we finally figured out that it was the end of the Cold War, that it was precisely those central banks that had built up significant bullion reserves in Western Europe for fear of another conflict. Because in a conflict, you don't know whose currency is redeemable. And if you have gold, you can be sure to get imports. And it was when 6 months or 3 months after the first Bush and Gorbachev declared an end to the Cold War, we saw the first substantial central bank sales, which lasted for the next 10 to 15 years. And now they've been buyers. And at that point, I think we should yield the floor to, for more intelligent and more insightful comments to my colleague, Rhona.
How I wish that was so, Jim, how I wish that was so. What is interesting, just picking up on your last comment about central banks having been buyers over the last few years, a lot of that buying has come from Eastern Europe, which may tell us something, not least Russia, but I was thinking more particularly about countries like Kazakhstan and so forth. Maybe they have been casting an eye over their shoulder to what may or may not come out of Russia, and been building up their reserves accordingly. Food for thought. I am going to go a little bit into inflationary trends and one or two other elements, and see how they, to some extent, match up with the gold price, but also just a little bit of background for some of the moving parts, certainly within the inflationary side of things. Thank you, Taylor. There is the StoneX disclaimer. And once people have had a chance to have a quick digest of that, if we could move on to the first slide, just so people to have a look while I'm running through things. Thank you. The misery index is basically, it's just a simple summation of, and you can do it for any country, but this is the United States, the unemployment rate and the inflation rate added together. There is a reasonable correlation in the shorter term. There isn't a particularly good one in the longer term, but that's probably fair enough, because the level of inflation, as Jim was saying, particularly over the course of the 90s and basically in the post Paul Volcker era, was such that the misery index was less significant, but it's become much more significant over the past 2-3 years or so, as you can see on the right-hand side of the chart. And the other clear elements were in the wake of the global financial crisis, and going back further, the second oil shock. So what I thought I'd have a look at with respect to that, and if we go on to the CPI as well, which is the next slide. Thank you. Again, the 47-year correlation is negative. Now, in both instances, the misery index and the CPI, the correlations with gold over shorter periods of time become much stronger, and particularly over the last couple of years. And that is understandable because of the impact that COVID has had, particularly with respect to supply chains. And then subsequently, we get the bounce back from recessionary or at the very least disinflationary environments. And we're now seeing that particularly in the labour markets in the States, or to a lesser extent to a much lesser extent in Europe. So as the time horizons shorten, so the correlations get higher, with the exception of the 3 years with CPI and gold. The 5-year is higher than the 3-year, and the 3-year is also lower than the 1 year. The 1 year is higher than both of the other two. So you have a dip in the 3-year period, which I suspect was a question of uncertainty, with people really not quite knowing how the pandemic was going to develop and what the knock-on effects were going to be. But at the moment, we're in a period where gold is actually showing good correlation with both those parameters. And I would point out, however, that correlation does not necessarily coincide with direction. It's much more a question of how the two elements trade against one another on a short-term basis. So having said that, I thought I'd take a quick look at some of the underlying trends that we're seeing in the major regions. So I'm going to kick off with just the headline numbers, and then I'm going to put a little bit of a twist on it. So bear with me for one tick, because the headline numbers year on year are still, they're a little bit misleading because they've still got baseline effects dropping out of the system, and some of them still holding on into the system. So the latest figures that we've got are headline year-on-year CPI for the United States at 8.5%, but with the factory gate prices at 11% and trending upwards. In the EU, the latest number for the harmonized CPI was 7.4%. And Bloomberg, I find this a very high number, but Bloomberg is reporting 31.4 for PPI, and again, trending upwards if we look back over the past 5-6 months or so. And then going over to the major gold consuming countries at a retail level at any rate, India's CPI was most recently at 7% with 14 or 15% PPI, and that PPI is fluctuating, which is probably understandable given the way that the Indian economy has been hit over the past 18 months or so, particularly with that second wave last year of the virus. China's an interesting one. China is coming in at the moment with its slowing down, and of course, obviously its lockdowns, at just 1.5% CPI and with 8% PPI, but that's actually trending downwards. So we've got a mixed message here. We've got upward PPI numbers in the major Western hemisphere, and then fluctuating in India and coming down in China. Now, again, this is obviously all to do with freight dislocations, supply chain dislocations, lack of labor, particularly for distribution when it comes to discharging at the ports. So to some extent, this is understandable. And as far as the States is concerned, the Beige Book was released yesterday, and that's the document on which the Fed relies pretty closely when it's framing its policy from the FOMC meetings. And it comes from 12 different Federal Reserve districts, such as Illinois, Minnesota, and so on and so forth. And it's the Fed does specify that the outcome of what is printed in the book does not necessarily reflect what the Federal Reserve officials themselves think. It's what they're getting from on the ground, from academics, from economists, and particularly, and most importantly, from industrial and non-financial service companies, the people who are at the coalface, basically. Most of the results of what they were collecting, and this is data up to the 11th of April, won't surprise anybody. It's all very well rehearsed, and we've already touched on quite a few of those elements already. But one thing that I did think was quite interesting was that they say that some contacts, they don't specify what kind of percentage, and I suspect it's quite a small number for now, were reporting early signs that the strong pace of wage growth has actually started to slow. You've still got a tight labour market, and you've still got people leaving their jobs to go to jobs with either greater flexibility or higher wages. So there's still a big dynamic moving through there. But it is possible that we're coming towards the peak. Now, what that does for cost push inflation further down the line is debatable, because what's happening at the moment is that while we've got high factory gate prices, a lot of companies are pushing those through down to the consumers. And at the moment, that's being absorbed. So I would suggest, or I would guess, that maybe by the time we get to perhaps the start of the fourth quarter of this year, maybe the start of next, we may well be seeing a different dynamic here. And the cost push and tight labor demand inflationary forces that we're seeing in the States may start to fall away. Now, having said all that, I've said quite a lot about dislocation. So an exercise which I think is probably of more value than just looking at the year-on-year changes is to go right the way back to March 2019, just before everything started to crumble, and take the compound average growth rate of the CPI, and I've done it for Europe and for the United States. So we miss out all the mess that we saw in the latter part of 2019 through to a good part of 2021. And if you do that for the headline inflation rate in the United States, it comes out an annual average increase of 2.3%, which is in line with just above, obviously, the upper end of the Fed's target bands for the Fed funds rate. Core CPE, which is the indicator that the Fed prefers to look at because it strips out food and energy. And we could have an intellectual debate about that in a completely different forum, because some economists agree that they should, some say that they should not. But either way, it is monitored. And that one comes in at 3.4% per annum. And in Europe, it comes out for the harmonized inflation number, that comes at also at 3.4% per annum. So to some extent, this is giving a little bit of a lie to the argument that inflation was purely and simply a pandemic result, with the knock-on effect once we've come out of recession or disinflation periods. Because, as I say, if you take that 3-year period, then it's still pretty high. and higher than acceptable for either of those central banks. Obviously, there is a dislocation in the past 6 months or so, but I do think that that longer period of time is more instructive than just looking at the short one. And just to round that out, obviously the big contributor here is energy. And the United States, excuse me, year on year, the United States change in overall energy prices was 32%, with gasoline up by 48, electricity up 11, and pipe gas at 22. And in Europe, I should say, then energy is up by 29%, electricity also at 29, and gas at 40. So particularly as far as Europe is concerned, Ukraine is going to be key to what we can expect there going forward. And obviously that's all still very much up in the air, I'm afraid. So if we move forward, could we go forward by 2 charts, please, Taylor? No, you've done it. I'm sorry, I beg your pardon, you're ahead of me. Yes, this is the final thing that I want to say, which is that you know you're in trouble when the dollar, treasury yields, and gold are all going up. Now, it's hard to see anything really in the majority of this slide here, but there is a period which lasted about 2.5 months, which goes back to what Suki was saying about the impact, and 3 months things go back to normal. This little area here, which I've outlined in the mauve and green lines on the left, it's very short-lived, but at least it was there. And that was in response to President Obama cutting taxes with the view to trying to improve the stimulus and economic growth as the US economy tried to pull out of the problems that were persisting in the wake of the global financial crisis. The Treasury market didn't like it at all. The dollar strengthened, partly on yields, but partly also, it should be said, because the European Union was independently struggling with its own efforts at recovery, and the euro was independently weak. And gold was benefiting from the risk-off mentality there. So then we have a relatively, I was going to say turbulent, that's not the word I mean at all, a relatively placid time over the course of the next 10 years or so. But middle part of 2021, you start to see the dollar turning round. Well, this one, I should say, sorry. And then you've got gold, and here you've got the yields. And obviously we all know what's happened to, this is the 10-year yield. We all know what's happened there over the past few months. So I would say, I'm not going to draw any particular conclusion or make any projections out of this, but I would say that these three taken together, that tells us it's time to batten down the hatches, I would think. So that's me done. If anybody has any comments, I'd be more than happy to engage in discussion.
I would just endorse what you said about when the dollar yields and gold are going up together. That happened during the global financial crisis. It's happened during the height of the trade frictions, and it's happened before. And this always is a sign of elevated risk. Absolutely right. And I think on the case of inflation in general, I can't think of one topic that there's been more misinformation and misdiagnosis in the gold market than inflation. And I remember when I first started covering inflation, inflation would go up, the CPI would rise, and the gold price would often go down, or the CPI would go down and the gold price would often rise. And I would think, this isn't what they told us at analyst school. Mm-hmm. And until I figured out that the gold market doesn't necessarily always respond to inflation, but it generally responds to the anticipated monetary response to inflation. So that's to say, if inflation starts to rise and the market becomes convinced that the global monetary authorities are going to act on it, the market may retreat. If they don't think that the reaction, the policy reaction is going to be effective, then the market may not retreat, which is the case in the 70s. And it's very easy to become confused. And we saw earlier in the year, actually, I thought Main Street was ahead of Wall Street. We saw when inflation was clearly rising towards the end of last year, we saw good coin and bar demand on the retail side, but not the institutions coming in on the ETFs and other side, because they still seem to be taking the sort of general central bank view. And the academic view was that inflation might be more transitory. Well, more recently, in the past couple of months, institutional demand has been up based on in large part on inflation, maybe triggered by Ukraine or not. But it does look as if the man on the street got a jump on the institutions there, and they've been riding the inflation gold argument higher. But again, be careful, because when the market becomes convinced that the global monetary authorities are really going to act and be persistent in it, this could cool gold. And I think it probably is right now.
Unless they're concerned that any such actions might not be successful.
Might not be effective, but precisely. So it's the confidence issue, right?
I agree with the comment that, and it's an important one to make, that when yields, dollar and gold all rising at the same time. I also think it's really great that you'd be able to put the inflation risks into context. We are so focused at the moment of the 2021 problems being compounded by the 2022 challenges, that we've been very much focused on what is driving inflation over the past few months, that it is important to look at that longer term base period and see what pressures we're actually building up. And I also think it's interesting just looking at correlations across the board for gold, because at the moment we're seeing some of those relationships breaking down, and of course we've seen geopolitical risks at front and center, but we're actually seeing a stronger correlation between gold and oil prices at the moment than we're seeing between gold and the dollar. So it's the factors behind gold at the moment are shifting, but we're also seeing a stronger correlation between equity markets and gold in the opposite direction. But also the inflation correlation at the moment has started to pick up. But if we look at it on a longer term basis, we normally say that gold is not an effective inflation hedge if it's being bought in the midst of rising inflation. It needs to be bought beforehand and held for at least 12 to 18 months. But also we tend to look at these periods between, at least in our analysis, when inflation is below 2% or when inflation is running between a normal range, say 2 to 5%, and then when periods where we see inflation or US CPI above 5%. And generally, if inflation is below 2%, we've seen annualized returns from gold around about 1%. If it's between 2 to 5%, annualized gold returns are around about 7%. But if inflation is running above 5%, which is where we are at the moment, annualized gold returns can be as high as 24%. And going back to one of the comments that you made, Jim, that gold outperforms not only other commodities, but other precious metals. If we compare gold's performance then in comparison to, say, the GSCI index, that only returned an increase of around about 21%. So gold is the stronger outperformer. But I think if we look at, maybe if we don't look at gold over the past 10 to 20 years and we go back to, say, the 70s and 80s, when we had inflation at such elevated levels, then we can see some similarities in terms of the oil price action, in terms of concerns around growth, in terms of inflation. And that was really a period where we saw a very strong outperformance from the gold market. And perhaps that's where we should be looking for indicative trends for gold in the current market, given that we're in a period where we haven't seen that relative stability that you're referring to, Rhona, earlier in the gold market recently. And as you said, Jim, we've had many more risks over the past 24, 36 months in comparison to the past 10 to 15 years.
Yeah. Yes, indeed. And this risk element feeds through to inflation. And I would agree that, you know, all the academic work does show that gold is, and that's what I meant when I said I can't think of anything that is more misdiagnosed than gold and inflation, because, as you say, it is an imperfect inflation hedge. But that doesn't mean that investors will not buy it because inflation is going higher. Even though over the long term, there are other more effective hedges, unless you get it in the right part of the cycle, which you pointed out a little bit before the inflation takes root.
Yeah, I think it's also important to reiterate the fact that it's overall it's a hedge against risk, and inflation is one component of risk. It's not the only one.
Yeah.
I think on that note, maybe I'll take us to the broader macro picture. And there were a couple of things I wanted to really delve a little bit deeper into. There's so many different outlooks that we can be focusing on when it comes to the macro outlook and what the main risks are that we're focusing on. One of the questions that we did see pop up was how has our outlook changed pre-Russia invasion to now? And certainly in terms of our growth outlook, in terms of our rates outlook, we have seen some significant shifts. When we're looking at the global growth forecast for this year, we're now forecasting global growth around about 3.4%. Pre-Russia invasion, we were forecasting global growth around about 4.4%. So that there is a significant shift lower in our growth forecasts, but also in our view in terms of the rate tightening cycle. So the first chart that I wanted to focus on looks at gold prices against yields and in comparison to the US recession in the past 40 years or so. So there's a much debate at the moment whether an inverted yield curve is in fact a useful indicator for the markets, and whether it's a useful indicator in terms of recessions and market positioning. And on the one hand, we can see that in the past, if there has been a recession, it normally materializes between 12 to 18 months, but that time frame is quite variable as well. And while an inverted yield curve precedes a US recession, it does not necessarily always lead to a US recession. We are not forecasting a recession, we're forecasting slower growth, but we're very mindful that the market is very concerned about slower growth, but we do think that we could see the yield curve inverted again for much of the second half of the year. So I think what's interesting here is just looking at how does gold behave during periods where we do see an inverted yield curve. We've also seen real yields closing in on zero over the past couple of weeks as well. So a lot of those dynamics that are usually critical for gold are shifting quite substantially. So we're forecasting quite a significant inversion in the second half of the year, to the extent or to the levels that we haven't seen since 2000. And while gold's price performance during periods of inversion is quite mixed, as it tends to be, because there's many other dynamics at play, if we look at how gold has performed since 2000, then we've generally seen that gold prices tend to rise during periods of an inverted yield curve, whether it's markets looking at rising inflationary risks, or the fact that we might see rates leading to recessionary risks. We do tend to see investors turning to gold during those periods. But we do think that with concerns around the potential for a recession, even though it's not our base case scenario, that more investors are likely to want to turn to gold, and that could in turn, in combination with the elevated geopolitical risks, offer a more stable floor for the gold prices. So we've already seen that price dips towards 1900, or the instance where we saw it dipping below 1900, have been greeted with much enthusiasm and has generally been seen as a buying opportunity. So for now, we think that the floor for gold prices is quite well supported. Turning to the next slide, here we're just putting into context our rate hike forecasts for the US in comparison to what the market is pricing at the moment. And we do think that the Fed has shifted to wanting to hike at a much faster pace, much more quickly, and larger increases than what we had forecast at the start of the year. So initially we thought we'd see a hike in March, May, June, July, each 25 basis points. But now we think that we're more likely to see a 50 basis point hike in May and June, and then a 25 basis point hike in July, and 25 basis point hike in December. So we think that the central governments around the world have become much more focused on concerns around inflation, and activity nor inflation has slowed anywhere near enough to derail the market expectations that we might see hiking at a much faster pace. But it also appears, the way prices are responding, that the markets have become a little bit desensitized to elevated risks, and there's a lot of uncertainty. So we're not necessarily seeing the sort of price response across various markets, across equities, for instance, that may be expected given the elevated risk and elevated volatility that we're seeing at the moment. So normally we would expect markets where we're looking at growth around about 3.3%, so 3.4% this year. That's a similar level to what we were initially forecasting for 2020, that if there was an additional supply shock in the market, that's when you would see potentially government stimulus or government support. But given the extraordinarily easy monetary policy that we've seen over the past couple of years, the cupboard is bare, so it leaves very little room for shocks to be accommodated. So that elevated risk is perhaps helping to provide a floor for the gold market as well. And we do think that global growth is vulnerable. We think that many central banks around the world are likely to tighten much more aggressively than what would otherwise have been expected, especially if inflation becomes much more of a greater problem. It could take a decade to fix rather than it being fixed by aggressive rate hikes. And we do think that in the May meeting, we'll see not just a 50 basis point rate hike, but we'll also see the start or quantitative tightening being announced as well. So the balance sheet contraction alongside with rate hikes is likely to lead to a much tighter or a much more aggressive policy than what we would have seen ordinarily. But we think for many central banks around the world, they believe that their window for action is actually starting to narrow as well. So they need to react now in order to be able to combat some of the inflation risks. So given that we're expecting quite aggressive rate hikes and the market's expecting this as well, and we see very little buffer for external shocks, we think gold has, on the one hand, is facing pressure from rising real yields, and we've seen real yields closing in on zero, but also the elevated concerns around geopolitical risks have kept gold prices higher than where we would have ordinarily expected. So for the gold market, there are a lot of forces that are keeping prices elevated, and we think that even when we start to see some of these aggressive rate hikes, we will start to see gold prices starting to ease in the second half of the year, but in comparison to historical levels, they'll remain quite elevated. And we're seeing a very similar trend across the precious metals as a whole, where it's not just concerns around inflation or slower growth, but it's the impact on perhaps supply disruptions, or even the impact on the auto market that could lead to losses in terms of demand that might see prices remaining quite volatile, at least for the next quarter or so. And I'll pause there, and I'd love to hear Rhona and Jim, your thoughts on rate hikes and the macro outlook.
I did a quick exercise yesterday. Basically, I cheated and went into Bloomberg. And there are, at the moment, if you look at the Bloomberg rate hike probability pages, there are only 7 central banks that have basically gone on record as saying that they're planning to hike rates. There's obviously many, many more who are considering it. But those who are on record as saying that it's in the offing are obviously the United States, Canada, India, United Kingdom, the Reichsbank of Sweden, European Central Bank, and the Reserve Bank of Australia, if inflation goes above its target band of 2 to 3%. So that's the vanguard. I suspect there's many, many more waiting behind.
Well, we too have looked for higher rates going forward, not dissimilar to you, Suki, and this is going to be the great duel between in the gold market going forward, and I'm not saying we're going to become inured to the geopolitical risks, but they have occurred, and we are learning to cope with them on a global level. And as we see, not just the Fed, but other central banks tighten, the combat in the gold market is going to be over those that think inflation will not be brought to heel by the Fed and other central bank actions, and those that think there's a good chance that it will. And we're on the side of gradually moderating inflation getting back, and as the Fed cuts, if the Fed heights continue to bite into the market, that will provide the major negative on gold going forward. And but we did raise our average price forecast to $1,820 from previous because of Ukraine and because of the inflationary impact. But like you, that is an elevated level, historically, and we shouldn't forget, the gold market is very, very high, and that should be taken into account. So even at that average level, it's still well above. But eventually, the monetary authorities, if determined, can get a hold on inflation.
Yeah, particularly if wages are starting to peak, or wages rise.
Yes. Yes, if the wage demand, which was not the case in the 70s, when wages fueled the spiral.
I think it's also interesting just looking at market positioning and ETF holdings leading up to a rate hike. Typically, we tend to see tactical positioning being cut back ahead of a rate hike, and ETF holdings tend to behave in a very similar fashion. And we've actually seen the opposite of this leading up to the March meeting, where we've actually seen a build in tactical positioning, and especially ETFs have been very, very strong. So I think that this is one area which could be viewed in both directions. It's an area of strength that shows that where the market focus is at the moment, but also if the market's focus shifts away from the geopolitical risks and back onto the rate hiking cycle, and we do think ultimately in the longer term, gold's relationship with real yields will become the dominant driver. That's where we could see some of this positioning being flushed out, and perhaps the downside risks for gold could start to build quite substantially, just given that positioning is quite elevated. But the ETF holdings tend to be a little bit more resilient, a little bit more sticky. So while we've seen some tactical positioning being flushed out, it does suggest that the floor for gold is a little bit more stable, given that it's been the build in ETF holdings that have really driven some of the movement in prices lately.
Yes, I think.
Yes. Sorry, Rhona, go on.
No, Jim, go ahead.
I was just going to say the other element, which is beyond the narrow scope of this webinar, is the impact on the underlying physical market as well. Jewelry is suffering because 70% of it is bought in price-sensitive economies, and also we can see that in import levels of imports to major non-OECD consumers, and that sort of leaves the market on one leg, overly dependent on investment. And if, as you point out, Suki, we do get any form of relaxation in geopolitical risks, and that withdraws or waters down an element of the current buying, then we're left with the market focusing on Fed rate hikes. Then that puts gold in a less tenable position than it is now.
Yeah, and the other element there with respect to the physical market is that when one thinks about the volumes that go through the OTC market and all the futures in bullion, they are a massive multiple of the actual commodity side turnover in the market. So we've got mine production of what's 3,600 tons, and spot turnover and the other derivative turnover is easily sometimes up to about 100 times that. So that will always be the dynamic that will be responsible for short-term moves and trends to a degree, whereas the physical market is normally quite good at cushioning falls, but it's never really of itself going to be strong enough to drive prices higher. And for that, you need it's like the oil tanker against the speedboat.
Yeah. Eloquently put, Rhona, very eloquently put.
I think we might have time for one last question before we have to wrap up. And I think we've discussed how our economic outlooks have changed. Taylor, were there any other questions that had come through?
Yes, we have one which is about the World Silver Survey, which was released by the Silver Institute yesterday, I believe. Was there anything that stood out to either of the three of you from that survey?
Well, I thought that the resilience of the silver market of industrial consumption was really quite outstanding. They had a significant rise in industrial demand and weighted a little bit, agreeably towards solar power as a function of higher oil prices, of course, and also electronics demand, even though the semiconductor market still isn't in full swing yet. But broadly speaking, I mean, even other aspects of industrial demand are very strong. And it does show that industrial production doesn't necessarily move with the wider global GDP cycle. It's going to be stronger relative to world growth this year, likely. And also the really important parts that silver plays within industrial production and how it is this marvelously dual metal of both industrial demand and monetary.
I would quickly add to that. Just that I think what struck me the most was the fact that we're now looking at markets that are potentially going to be undersupplied, not just last year, but going forward as well. And we know that silver, like gold, has its commodity attributes and its currency attributes. So it's both its underlying demand that's driving silver, but also where we see macro interest. But I think the fact that we're seeing such strong growth potential when we're looking at alternative energy, or whether we're looking at cleaner fuel, it's the fact that we're likely to see a higher floor for the silver market as well. That's being driven by the industrial side. But if we see a market in deficit, we're not necessarily going to see substantially higher prices if the investor interest is not present. But also the fact that the ETF holdings have been quite resilient. I always think it's a positive in the gold market when we see both inflows and outflows, because any stale positions are being flushed out, and it's healthier for the market to have new fresh interest in the gold market. Whereas in silver, we tend to see much more sticky, resilient interest on the investor side, even if they're holding on to a loss-making position for a little while longer than what we might expect.
It's got a higher retail component than gold, hasn't it, in the silver ETF?
Yes, much. There was an amusing, and Suki, I'm sure you remember this, and I just want to share with everybody very quickly, this confusion over real rates. When it was being discussed in the Q&A at the Silver Institute, there was a question from the audience pointing to sharply negative real rates because of high inflation, 8.5%, and nominal yields being below 3%, and there was a lack of understanding that what many presenters or when they look at the 10-year, that is the break-even level for what people think inflation is going to be 10 years forward. Was some of the questions from the audience was centering on current inflation and arguing that therefore rates were massively negative. And I come up against that all the time. And I'm not saying I understand it perfectly myself, but it does add to this confusion over inflation in general, and at a very sophisticated audience level. Suki, I don't know if do you remember the discussion?
Yes, it does come up repeatedly, just wanting to look at nominal levels and then looking at 10-year levels. It's and it can be confusing, and I think it's not even straightforward when we're looking at the level of inflation, because that matters as well for all the precious metals.
And I'm far more easily confused than either you and Rhona, I can assure you.
Methinks he doth protest too much, ladies.
Excellent. Well, thank you very much for your time, James Rhona and Suki, and for answering those questions. I have seen that there are a few more that have filtered through. Unfortunately, we have run a little bit over time, but what I will do is I'll send those across to the panelists for them to respond to you directly. And again, if you do have any questions which come to you after the webinar, we are watching recorded, do send those through to us at ask@lbma.org.uk, and we'll send them through to our panelists, who will happily oblige and answer, I am sure. That is the webinar for today. I will just quickly take you through some upcoming webinars and events that we do have. On the 19th of May, we will be releasing a recorded webinar. As many of you know, it is Platinum Week. So we're not going to subject you to another live webinar during that very, very busy time, but we will be releasing a session from our recent Sustainability and Responsible Sourcing Summit. So further details to follow on that. We do have 2 training days at the end of June on the 9th and 10th, Thursday and Friday. They will be our Introduction to Loco London and our How to Use Loco London courses respectively. So if you want to know more about those courses, do get in touch. And then a little save the date for the 7th of July, which is our annual general meeting. And of course, as always, our registration is open for the Global Precious Metals Conference from LBMA and LBPM. We're now on our standard ticket rates, so do register for that. We're looking forward to having you there finally after so many years of planning. If you do have any questions, just drop us a line and we'd be more than happy to answer. So finally, panelists, attendees, thank you so much for your time, and we look forward to seeing you on another webinar in the future.